Hi, I'm Karthik. Today I'll be explaining about break-even analysis. So, the purpose of break-even analysis is for firms to estimate the rate of production so as to maximize their profit. So, let's come to what is actually break-even analysis. The definition of break-even analysis, according to Mads, Curry, and Frank, is that it is a state where cost and revenue are at equilibrium. So, break-even point is a point where the cost put in by a firm and the revenue that it gains through its production and sales is the same. So, it's the point of no profit and loss virtually. We can look at this graph which can explain break-even point better. So the blue line represents the uh, cost spent, and the yellow line represents the revenue. So the point where cost and revenue meet and there is no profit or loss is the break-even point. The point below, the area below break-even point is the area of loss, and the area above break-even point is the area of profit. So as you can see, the break-even point is where no profit or loss is there. So the revenue is exactly equal to the production cost. Now, break-even point has two components: fixed costs and variable costs. So the total cost of production is divided into fixed costs and variable costs, wherein fixed costs include costs that do not change over a long period of time, like taxes, salaries, rent, energy cost, labor cost, and interest that should be paid for loans. Whereas variable costs change every month or every year, they change on a different they change periodically, like the cost of material, packaging cost, and fuel cost. Now, break-even analysis is done based on a few assumptions. The assumptions are that the total cost is classified into fixed and variable costs, and no other costs will be included in the total cost. So, any cost apart from fixed and variable costs, like sudden revamp costs or renovation costs, will not be included. The price of the product is assumed to be constant. The volume of sales and production are equal, meaning there is no inventory or extra production that is made. The exact amount of production that is made is sold. So the volume of production and sales is equal. The fixed costs remain constant over a long period of time. Technology and methodology remains constant. So the method of production and the technology used remains constant over a long period of time. And the labor quality remains constant, meaning that the efficiency with which employees work in order to achieve a certain amount of production is the same. So the employee efficiency, which can be variable, is not taken into account while setting the assumptions for break-even analysis. Now let's look at what outcomes are uh, yielded out of break-even analysis that companies like to look at. So break-even analysis gives a firm an estimate over the sales volumes. So for example, let's say a company is set to break even at the end of 4 years. So the amount of sales that they should make in these 4 years to achieve the profit by the set time of 4 years is estimated through the break-even analysis. Next, very important outcome is the pricing strategy. So this helps the company price their products in accordance with what their competitors' prices are, so that their products make profit as well and are affordable to the customer as well. It is a point of no profit and loss, so it helps the firm estimate at what point it would be uh, starting to gain profit. Next is the applications of break-even analysis. So as I mentioned before, break-even analysis helps in determining profit and loss and to fix selling prices. It also helps a firm decide make or buy decisions, wherein the company can decide whether production should be in-house or it should be outsourced, or certain materials should be brought from outside and then assembled in-house. It also helps the company expand business domains. For example, if a particular product is not working, it helps the company expand its domain and go to a new product and stay relevant in business by expanding their product portfolio or by changing their methodology. It also helps them determining their marketing strategies and set their sales targets so as to achieve maximum profit. And it helps in long term business planning. So, one major application of break even analysis is that it helps analyze performance and manipulate your business strategy accordingly so as to reduce the amount of loss and maximize profit in every set period of time. It also helps a firm determine the margin of safety and inventory analysis. So every company produces such a certain amount of inventory apart from the estimated volume of sales that is made. So the margin of safety or the amount of inventory, extent of inventory which can be made, the maximum amount of inventory that can be made so that the company doesn't make too much inventory and end up spending on storage cost, is the margin of safety, which can be analyzed again based on the break-even point. Another important application of the break-even analysis is risk anticipation and mitigation planning. Suppose the break-even analysis estimates that the company is expecting a dip in sales and there is a risk that the company might dissolve into bankruptcy. The company might mitigate the risk by entirely liquidating its assets or merging with another company and continuing business. So, that being said, there are a few limitations of break-even analysis. The major one being that costs and revenue keep changing based on global economic landscape. For example, the global economic downturn brought by the COVID-19 uh, made a lot of changes in the costs and revenue, where the costs went up and revenue went down, and it was vice versa in terms of certain industries. So these sudden changes in costs and revenue is not taken into account while doing break-even analysis, which can be a limitation. The second limitation is the frequent supply and demand fluctuations. A recent classic example being the uh, crisis in semiconductor supply, which affected a lot of electronic industries. The next limitation is the factors influencing profit apart from output. So, like I said before, employee efficiency and some other factors are not considered into break even analysis, which can be a problem later because there are a lot of factors apart from just output or the sales volume that determine the profit or loss made, like sudden economic downturn, or there can be a market condition that arises suddenly. There can be a sudden problem in transportation and logistics that can disrupt the profit and loss quite considerably. And there is a questionable accuracy as to how much accounting data is accurate, especially when accounts are made manually. So the break-even analysis is based on a lot of accounting data. So when the accounts are made manually, there is a lot of error potential that comes in. So that can be one limitation. Now, concluding my points about the break-even analysis, it is an umbrella term that is subject to a lot of limitations and assumptions, but it is an instrumental economic tool which helps a company determine its profit and loss estimate, and it helps a company determine its business strategy so as to stay relevant in business, and also a lot of factors like the sales target and the marketing strategies. So that was about break-even analysis. I hope you got an idea from what I explained.